What if the greatest financial risk to your future isn't a stock market crash, but your government's addiction to debt? Every year, governments borrow more, pushing the costs onto citizens through higher inflation, heavier taxes, and rising interest rates. This isn't just a policy issue, it's something that touches your wallet, your mortgage, and even your job security. So why are governments addicted to debt, and can they ever break free? Let's start simple. A deficit is when a government spends more in a year than it collects in revenue. The debt is the running balance of all those past deficits added up. Think of it like a credit card. The deficit is this year's swipe. The debt is the bill that keeps piling up. Who holds this debt? Pension funds, banks, foreign investors, central banks, and even you through bond funds in your retirement account. Debt keeps rising because politicians promise more than they collect. Unexpected crises blow holes in budgets, and aging populations make entitlement costs climb automatically. Here's the core of the addiction. Politicians are locked in short election cycles. They win votes by offering benefits now and delaying the costs until later. Voters accept the trade, services today, taxes tomorrow. The economy itself encourages borrowing. When recessions hit, unemployment benefits rise and tax revenues fall, pushing deficits higher automatically. And then there are crises like wars, financial meltdowns, or pandemics, when governments borrow massively to save the system. Those emergency measures rarely unwind completely, leaving debt permanently higher. Now, let's simplify the mechanics. One key concept is the primary balance. That's the budget before interest payments. If you're in primary deficit, you're borrowing even before paying interest. Another is R minus G, interest rate minus growth. If growth is faster than borrowing costs, debt can shrink relative to the economy. But if interest rates rise above growth, debt snowballs. For years, governments borrowed cheaply because interest rates were near zero. That safety net vanished when rates spiked, and suddenly interest bills exploded. Central banks played a huge role here. Quantitative easing, QE, meant central banks bought up bonds, keeping borrowing costs low. That worked like a cushion under the debt market. But markets also discipline governments. If investors fear runaway spending or inflation, they dump bonds, pushing yields higher overnight. We can see this addiction across the world. In the US, debt shot up after the 2008 crisis and again during the pandemic. As rates rose, interest costs became one of the fastest growing budget items, now rivaling defense spending. Japan looks different. Debt is more than twice the size of its economy, but yields stayed low for decades because most of the debt is held domestically and the central bank kept control. Europe is trickier. Countries like Italy don't issue their own currency. They rely on the European Central Bank as a backstop. If markets doubt their solvency, borrowing costs soar until the ECB steps in. Emerging markets show the harshest version. In Argentina or Turkey, heavy borrowing combined with weak credibility led to collapsing currencies, triple-digit inflation, and soaring rates. When governments don't control the currency or lose trust, the spiral is brutal. Not everyone agrees this is a crisis. Modern monetary theory argues that countries controlling their own currency can always finance spending, with inflation being the only real limit. And when interest rates are lower than growth, debt burdens can stabilize naturally. But here's the catch. If inflation rises, central banks are forced to hike rates, flipping that R minus G equation the wrong way. Credibility matters too. Investors must believe a government will control inflation. And demographics add pressure. As older populations demand more benefits, while the workforce shrinks. So what happens if the addiction continues? First, interest costs crowd out other priorities. Every dollar spent on debt service is a dollar not spent on schools, infrastructure, or tax relief. Second, inflation risk rises if governments keep spending without discipline. Third, growth and productivity suffer when uncertainty increases and public investment gets squeezed. And finally, ordinary citizens may face stealth taxes, ace inflation, and financial repression quietly erode savings and wages. What could break the cycle? Demographics matter. Higher labor force participation, immigration or family policy could boost growth. Entitlement reform, like adjusting retirement ages or slowing benefit growth, could bend the curve, though it's politically unpopular. A productivity boom, perhaps from AI or technology, could help economies outgrow their debts. Fiscal rules and credible budget frameworks can work, but only if politicians stick to them. And then there's the harsh option, a market revolt, where bond yields spike suddenly, forcing governments to adjust whether they want to or not. So what can you do as an individual? Manage your own rate risk. Favor fixed rates over variable if borrowing. Diversify your investments across equities, inflation-protected bonds, global markets, and select real assets. Keep an emergency cash buffer so you're not forced to sell in downturns. And don't over-leverage. Cheap money is gone and debt is expensive again. Above all, keep a long-term horizon. Governments may be addicted to debt, but disciplined households can still build wealth through time and compounding. Here's the recap. Governments are addicted to debt because politics rewards short-term promises, crises pile on borrowing, and voters rarely demand the opposite. Low rates mask the costs, but rising rates have exposed them. The addiction carries real risks: crowding out, inflation, weaker growth, and less fiscal freedom. But individuals have tools to protect themselves. If this helped you understand the debt dilemma, hit like, subscribe to MacroMentor, and share this video.